Welcome back to Investing Talk Podcast. We're here to help you navigate the complex world of finance, cutting through the noise to bring you insights that truly matter.
Good to be back.
Today, we're tackling a question that's definitely on many investors' minds. Is Fubo TV a good time to buy now?
Yeah, it's a popular one, especially in that streaming space.
Exactly. It's such a competitive sector. And look, we've gathered a stack of recent sources, everything from SEC filings, analyst reports, to the latest news, to give you a truly comprehensive look.
Right.
We'll be breaking down Fubo TV's financial health, their competitive landscape, recent strategic shifts, and, what potential catalysts could be on the horizon.
Trying to get behind the headlines, really.
That's the mission. Extract the important nuggets and help you understand what's really going on. Before we unpack all the details, if you find this kind of analysis valuable, please make sure to subscribe, like this episode, and leave us a comment.
Yeah, we love hearing from you.
And definitely, if there's a specific company you'd like us to look into for a future conversation, please let us know below. Your input really helps us decide what to explore next. Okay, let's start by diving into Fubo TV's financial performance. On the surface, the top-line numbers show growth, right?
They do. Latest reported annual revenue for 2024 hit $1.02 billion. That's a 13% increase year over year. Pretty solid.
And their Q2 2025 revenue came in at $379.97 million.
That's right, with subscription revenue making up most of that, $352.67 million.
So that sounds encouraging, but what's the real story underneath those figures?
It's true that the top line shows growth, but here's the crucial insight. Fubo TV remains unprofitable on an annual basis if we look at their core operations.
Oh, aim unprofitable.
Yeah. While their Q2 2025 operating loss of like $5.99 million was a significant improvement compared to the $35.68 million loss in Q2 2024.
Which is a big improvement.
It is, absolutely. But it's vital to consider the full picture. The reported net income of $180.46 million for the 6 months ending June 30th, 2025. Well, that was primarily driven by a one-off $219.5 million litigation settlement gain.
Ah, the settlement gain. Okay.
Exactly. It's a bit like, finding a winning lottery ticket. Great in the moment, but you can't really build a sustainable business strategy around it.
Makes sense.
So, excluding that non-recurring gain, the core business continues to operate at a loss. This raises an important question for you. How sustainable is their path to profitability without these one-off windfalls?
That distinction is absolutely critical. So while a net income figure might look appealing at first glance, the underlying operational reality is still, red ink.
Pretty much.
Given that, how can investors genuinely assess their path to sustainable profitability?
Yeah.
Does this immediately put immense pressure on their gross margins, or?
Well, you've hit on a key point. The pressure on margins is certainly there. Their gross margin for FY 2024 was 12.3%, which was a slight increase year over year, so that indicates some efficiency improvements. But management hasn't provided explicit forward guidance on earnings.
No guidance.
Not explicitly. Instead, they've emphasized a strong focus on cost discipline to eventually reach break even, which, suggests they are keenly aware of the need to convert that revenue growth into sustainable core profitability.
Rather than relying on external events.
Exactly. So for you, the investor, this means watching for concrete signs of that cost discipline actually translating into improved operational profits in future reports.
So while the revenue numbers are there, the real question is sustainability. Okay. This leads us naturally to their broader financial health beyond just the top and bottom lines.
Right, the balance sheet.
Particularly how their cash position and debt stack up. As of December 31st, 2024, Fubo TV had $317.3 million in cash and cash equivalents. But they also carried $452.3 million in total debt, including convertible notes. What do those numbers tell us about their financial runway?
This highlights a common yet critical challenge for many growth companies, right? While their cash position of $317.3 million does offer a sufficient runway for, say, near-term operations.
Look at near-term.
The negative cash flow from operating activities, which was negative $59.5 million for FY 2024, that's a bit of a red flag.
Negative $59.5 million. Wow.
Yeah. It suggests that longer-term funding needs could become a significant risk if they don't achieve profitability and, start generating cash soon.
Makes sense.
And what's also a significant point to consider for you as an investor is the risk of shareholder dilution.
Right. More shares being issued.
Exactly. As the company issues new shares, maybe through ongoing equity awards or the recent registration of up to 23 million shares in 2025, Your existing ownership stake effectively gets a little smaller.
Potentially impacting the share value.
It could, yeah. It's a trade-off many growth companies make, but it's crucial for you to be aware of that potential impact.
Indeed, that potential for dilution is a significant factor. But let's shift our gaze from the balance sheet to the battlefield Fubo TV is fighting on.
The streaming wars.
The fiercely competitive streaming arena. They're going up against giants like YouTube TV, Hulu Live, Sling TV. I mean, the list goes on.
It does.
What exactly is their differentiator, and how strong is their competitive position in such a crowded market? Fubo TV here seems like, I don't know, David facing multiple Goliaths.
That's a great analogy. Fubo TV's main differentiator is indeed a strong emphasis on live sports.
Okay, sports focus.
Coupled with proprietary streaming technology and, interestingly, integrated betting features through their sportsbook offering, they're really trying to carve out that niche for the avid sports fan.
But is it working? I mean, how strong is that edge?
Well, if we connect this to the bigger picture, their competitive edge remains somewhat limited. Those larger competitors aren't just big, they have immense scale. Established sports rights, often locked down for years, and significantly deeper capital pools. Just way more money.
Which means...
It means Fubo TV's margins are structurally pressured by high content costs. It's just a very tough market to gain a significant, sustainable advantage in.
So that niche focus is smart, but maybe not enough.
Building a truly unassailable moat against such well-resourced players is, let's say, an ongoing challenge.
So they're fighting an uphill battle on content costs.
Right.
Okay, now for those of you who track price action and chart patterns, let's talk technicals for a moment.
Sure.
Fubo TV's recent price range, past 30 days, has been relatively tight, hasn't it? Between about $3.40 and $3.95.
Yeah, pretty narrow range.
Looking at the charts, we see Fubo TV finding some foundational support around the $3.20 to $4.40 mark. That could be a level where buyers might step in.
Potentially, yeah, a floor maybe.
On the flip side, it's facing resistance near $4 to $4.20. Suggests a bit of a ceiling for upward movement in the short term. And while its 50-day moving average is creeping up slightly, it's still trailing the longer-term 200-day average.
Which is often seen as neutral. Cautious.
Exactly.
Yeah.
A classic technical signal, often read as neutral to cautious. It hints that while there's some recent momentum, a strong bullish trend isn't fully established yet.
And the RSI.
The Relative Strength Index, yeah.
Yeah.
It's sitting at 53 right in the middle, suggests no strong immediate upward or downward momentum right now. Now, let's talk about recent news and strategic shifts, because this is where I think a lot of the dynamic changes for Fubo TV have been happening.
Definitely some big moves lately.
The most striking recent development, as of September 2nd, is the launch of their Fubo Sports service.
Right, the skinny bundle.
Yeah, emphasizing sports content for $55.99 a month or $45.99 introductory. What's the significance of this new offering?
Well, this is a crucial strategic shift, and it's deeply tied to an even bigger development. What's truly insightful here?
The Disney deal.
Exactly. This new service emerges after Disney acquired a controlling 70% interest in Fubo TV through that antitrust lawsuit settlement.
Okay, so it's all connected.
Very much so. Fubo Sports is now strategically positioned within Disney's broader streaming ecosystem. This move, finalized after 6 months of legal wrangling, provides significant clarity for Fubo TV's strategic roadmap.
And fundamentally changes the competitive landscape for them, I'd imagine.
Completely. It's no longer just Fubo TV against the world. They now have a very powerful parent company.
So a major shift in ownership and strategy. That's certainly a game changer. And speaking of recent developments, we also saw some preliminary Q2 2025 results from July that seemed pretty positive.
They were. Those preliminary Q2 results indeed exceeded prior guidance across several key metrics.
Like what?
North American revenue was above $365 million. Paid subscribers topped 1.35 million, and they reported an improved net loss of approximately $8 million.
An $8 million loss is better than expected then.
Significantly better. And perhaps most importantly, they achieved their first ever positive adjusted EBITDA.
Positive adjusted EBITDA. That's a milestone.
A big one. At least $20 million. For those less familiar, adjusted EBITDA often gives a clearer picture of operational profitability by stripping out non-cash stuff and one-offs. Gives you a truer sense of the underlying business performance.
And their cash looked okay too.
Yeah, cash reserves look solid at roughly $285 million at the time.
That's a lot of positive movement. But hang on, if we connect this back to our earlier point about the core business being unprofitable without those one-off gains, how do these positive results align? Is Fubo TV actually turning a corner?
That's precisely the critical question these results raise for you, isn't it?
Yeah.
They certainly suggest operational improvements and a strong move towards efficiency, particularly with that positive adjusted EBITDA. But due to the pending Hulu plus live TV business combination and, crucially, Disney's majority control, Fubo TV actually withdrew their 2025 profitability guidance.
Old guidance.
Yeah, and paused long-term projections. This indicates they're in a period of significant transition and, frankly, reevaluation.
So things are still very much in flux.
Exactly. While analysts like Needham and Wedbush did raise price targets and issue buy ratings after these strong July results and the newfound strategic clarity,
The market liked it.
the market reacted positively, yes. But the company itself is signaling a pause to basically recalibrate its future path within the whole Disney structure. The long-term picture is still being redrawn.
So market optimism, but internal recalibration. Definitely something to watch. Looking ahead then, what should investors be keeping a close eye on? What are the potential catalysts that could move the needle for Fubo TV soon?
Well, in the short term, the next earnings release, expected early November 2025.
Crucial report, I guess.
Absolutely. Particularly for any new guidance, commentary on profitability, and importantly, any details on synergy with Disney assets. How are they actually going to work together?
Right. Any other catalyst?
Could be announcements on new sports rights, maybe strategic partnerships that leverage their new ownership, or further cost-cutting initiatives that show tangible results.
And the Fubo Sports launch.
Oh, definitely. A critical focus for you in the coming months will be subscriber growth and margin improvements directly resulting from that Fubo Sports launch. Does it work? Does it bring in profitable subscribers?
And maybe some market mechanics stuff?
Could be. Institutional activity, ETF rebalancing in November, that could also influence share price volatility. Something for traders to watch.
And beyond the sort of confirmed catalysts, there are always rumors swirling, aren't there? What's the chatter telling us about Fubo TV's future?
Well, there's definitely market chatter about potential strategic partnerships, maybe with major sports leagues or tech partners, that could significantly broaden their reach and content.
Makes sense. What else?
And perhaps more dramatically, there's speculation about M&A activity. Insiders are speculating about a full absorption of Fubo TV by Disney. Yeah. That certainly raises an important question about Fubo TV's ultimate destiny within the Disney ecosystem, doesn't it?
It really does.
Industry experts also anticipate new cross-service bundles, Disney Fubo bundles, which could significantly boost subscriber retention and acquisition, especially heading into the holiday sports calendar.
Okay, lots of possibilities there. Given all these moving parts, the new ownership, the strategic shifts, the market dynamics, what are the primary risks you, as an investor, should be acutely aware of?
Well, first, the company's own filings, the latest 10K, it notes material uncertainties regarding Fubo TV's ability to actually achieve and maintain profitability. That's fundamental.
Yeah, profitability risk.
Then there's the continued dilution risk from equity incentive plans, insider share sales. We talked about that. That could affect per share value.
Okay.
High customer acquisition costs and subscriber churn, people leaving the service, those remain elevated. That risks sustained cash burn if they can't get it under control.
And the market itself.
Competition is fierce. Larger players could easily outbid Fubo TV for crucial content rights. And finally, the streaming sector itself is inherently volatile, and Fubo TV is particularly sensitive to consumer discretionary spending. If the economy tightens, people might cut back.
Lots of risks to weigh, so let's try to bring it all together. Considering all the sources we've looked at, the overall rating we landed on for Fubo TV is a 3 out of 10. Can you walk us through the rationale behind that assessment?
Absolutely. Look, on the positive side, we have seen some encouraging signs. Narrowing cash burn, operational improvements. That first positive adjusted EBITDA in Q2 2025 was a real milestone.
And the cash balance.
The $317 million cash balance from late 2024 ensures a short-term runway, gives them breathing room. Plus, their focused live sports positioning and unique tech integrations are clear strengths. They do have something different.
Okay, those are the positives. What about the negatives pulling that score down to a 3?
Well, the challenges are significant. The core business is still unprofitable if you strip out those non-recurring gains, like the settlement. There's high dilution risk for you as a shareholder. There's a relatively weak competitive moat against larger, much more resourced incumbents.
The Goliaths.
Exactly. And cash burn trends, while improving, remain negative overall, hinting at possible future funding needs down the line.
So less confidence in the long term.
Ultimately, there's just limited evidence right now of sustainable long-term profitability or consistent shareholder value creation that doesn't rely heavily on external factors or now its parent company, Disney.
So what does this all mean for you as an investor considering Fubo TV right now? Bottom line.
This suggests that Fubo TV is probably best suited for short-term trading, based on volatility, event-driven moves like the impact of the Fubo Sports launch or upcoming earnings reports.
But not long term.
Generally, it's not recommended for a long-term buy-and-hold investment. Not until clearer evidence of sustainable profitability, reduced dilution risk, and maybe a more robust competitive position is firmly established. It's really a story in transition, and long-term investors typically prefer a clearer destination.
That's a lot to consider for Fubo TV. It's clear they're at a pivotal turning point. Disney's controlling stake, the new Fubo Sports launch. It creates both significant opportunities and, frankly, profound questions.
Indeed. The true impact of these strategic shifts on subscriber growth, profitability, and their competitive standing, that's going to be key to watch over the next few quarters. The journey ahead for Fubo TV is anything but dull, that's for sure.
We hope this comprehensive look has provided you with some valuable insights. Understanding these dynamics is crucial for making informed decisions.
Absolutely.
And here's a provocative thought for you to mull over as we wrap up. In this rapidly consolidating streaming landscape, does Fubo TV's future lie in truly becoming a successful, niche, specialized sports service that thrives under Disney's umbrella? Or will its integration with such a media giant ultimately lead to its full absorption, changing its identity entirely? Something to think about.
A very interesting question for the future.
Thank you for joining us on Investing Talk Podcast. We'll be back soon with another in-depth look into the world of finance.
Thanks for listening.
If you enjoyed our conversation, please like this episode, subscribe for more insights, and definitely leave us a comment. Your feedback helps us choose our next topic.